Price movement on a trading chart tells a story of market behavior, showing how buyers and sellers interact over time. Every shift in price, whether upward, downward, or sideways, reveals changes in supply and demand, market sentiment, and trading volume. When prices move upward consistently, it usually indicates strong buying interest or optimism in the market, often triggered by positive news, earnings reports, or broader economic indicators. This upward movement, known as an uptrend, can signal that traders believe the asset will continue to gain value. On the other hand, a downward movement reflects selling pressure and often suggests fear, uncertainty, or negative developments, such as weak earnings or unfavorable economic data. A downtrend often triggers further selling as traders anticipate lower prices. Sideways movement or consolidation shows indecision. Buyers and sellers are relatively balanced, and the market is waiting for a catalyst to break out in either direction. These phases are crucial because they often precede significant price moves. Beyond just direction, price movement also shows volatility, or how fast and unpredictable price changes are. Sharp spikes or drops within short periods can signal news events, market reactions, or speculative trading. Slow, steady moves may reflect more stable market conditions. Additionally, price patterns like flags, triangles, and head and shoulders formations appear through these movements, providing traders with clues about potential future direction. Observing these patterns can help traders make more informed decisions about entry and exit points. Price movement also reflects psychological factors such as fear, greed, and confidence. Traders often react emotionally to market events, creating recognizable patterns in chart behavior. For example, a sudden rally might result in panic buying or FOMO, fear of missing out, pushing prices even higher. Conversely, a steep decline can trigger panic selling, driving prices further down. Support and resistance levels also emerge through price movement. Support represents a price level where buyers consistently step in, while resistance shows where selling pressure tends to build. When price breaks these levels, it often leads to significant moves in the direction of the breakout. By understanding how price behaves around these key levels, traders can better anticipate potential reversals or breakouts. In essence, price movement is the raw language of the market. It doesn't rely on lagging indicators or external analysis. It tells traders, in real time, what the market is doing and how participants are reacting. Whether you're trading short-term strategies like scalping or longer-term setups, reading price action gives you an edge in identifying trends, timing entries and exits, and managing your risk. Every candle, bar, or tick contains valuable information that, when interpreted properly, helps traders stay one step ahead.